$113,208. That's the amount the IRS will force you to withdraw from a $3 million IRA the year you turn 73, whether you need it or not, whether you want it or not. Now, most people hear that and think, okay, I'll pay some tax on it and move on. But that $113,000 withdrawal triggers a chain reaction that many retirees, and honestly, many accountants, don't see coming until the first 1099-R lands in the mailbox. After working with hundreds of affluent retirees across the United States, I can tell you the RMD itself isn't the problem. It's the four dominoes that fall after it. And by the time you see the damage, the window to prevent it has already closed. Today, I'm going to walk you through exactly what happens when a $3 million IRA hits the RMD trigger at 73. Not just a withdrawal, but the full four-domino tax cascade that can cost you $15,000 to $20,000 or more per year on top of the income tax you already expected. I'll show you the actual 2026 numbers. I'll run through a hypothetical case study with David and Karen so you can see exactly where each dollar goes. And then I'll give you the three remaining levers to reduce the damage, including one that's more powerful in 2026 than it's ever been. So stay with me through the end because the third lever is something I think most people overlook entirely. So here's what I need you to understand before we get into the numbers. Most people think of an RMD as one event, a withdrawal with one sequence, a tax bill. That's how your 1099-R makes it look. One line, one number, but that's not how it works. A $113,000 forced withdrawal from a $3 million IRA doesn't just create taxable income, it raises your adjusted gross income across every system the federal government uses to determine what you owe. Social Security taxation, Medicare premium surcharges, tax bracket placement, deduction eligibility. Each system looks at that same inflated AGI number and reaches its own conclusion. And none of them are in your favor. Think of it like pulling a thread. You didn't just take $113,000 out of your IRA. You changed your tax identity. And every system that looks at your income now sees a different person than who you were the day before that distribution. One of the most expensive things you can do with a $3 million IRA is nothing. And I don't say that to scare you. I say it because the people who understand this in their early 60s have options. The people who find out at 73, their options are a lot more limited. So let me show you exactly what I mean. Picture David and Karen, both 73, married, filing jointly, living right here in Richmond, Virginia. David spent 35 years as a senior project manager. Did a lot right, maximized his 401k contributions for decades, and rolled it all into a traditional IRA when he retired. That IRA is now worth $3 million. They collect $60,000 in combined Social Security. They have about $15,000 a year in investment income from a small taxable brokerage account. No pension. David calls me and he says, I know I have to start taking distributions. How bad can it be? Let me walk you through exactly how bad it gets. The first domino is the one that surprises people the most. David and Karen's required minimum distribution is $3 million divided by 26.5. That's the IRS Uniform Lifetime Table divisor at age 73. That comes to $113,208. Now, to determine how much of their Social Security gets taxed, the IRS uses something called provisional income. Here's the formula, and I'd encourage you to write this down or screenshot it. You take your AGI, that's everything except Social Security, and add half of your Social Security benefits. For David and Karen, $113,208 from the RMD, plus $15,000 in investment income, plus $30,000, which is half their $60,000 in Social Security. That gives them a provisional income of $158,208. Here's where it gets a little painful. The threshold where 85% of your Social Security becomes taxable is $44,000 for a married couple. David and Karen are at $158,000. They don't just exceed it, they obliterate it. That means 85% of their $60,000 in Social Security, which is $51,000, gets added to their taxable income. That's $51,000 in income they would not have owed tax on if it weren't for the size of that RMD. And here's the part that I think everyone should know. Those $32,000 and $44,000 thresholds, they were set in 1983 and 1993. They have never been adjusted for inflation, not once in over 40 years. If they'd been indexed the way tax brackets are, that $44,000 threshold would be somewhere around $120,000 today. Congress didn't forget to adjust them. This was actually by design, a slow motion expansion that catches more retirees every single year. According to the Congressional Research Service, the share of Social Security benefits subject to taxation grew from about 12% in 1994 to over 38% by 2022. For anyone with a $3 million IRA, there is zero chance of avoiding maximum Social Security taxation while taking full RMDs. None. And keep in mind, David and Karen are a hypothetical couple I'm just using for illustrative purposes. This does not represent actual client results, and your situation will certainly depend on your specific income, filing status, and of course, other factors. So at this point, I'm curious, have you ever checked what your percentage of your Social Security is currently taxable? Drop a comment. It's one of those numbers that surprises a lot of folks. Now, the second domino is more straightforward, but it builds on the first. David and Karen now have an AGI of roughly $179,208. That's the RMD plus $51,000 in taxable Social Security plus the $15,000 in investment income. They subtract their standard deduction for a married couple, both over 65 in 2026. That's $32,200 plus $1,650 per person, so $35,500 total. They also receive $8,495 in enhanced deduction for seniors, and that leaves them with about $135,213 in federal taxable income. That puts them squarely in the 22% marginal bracket, which in 2026 runs from about $100,000 to $211,400 for married filing jointly. Their estimated federal tax bill will be approximately $19,171. Now, $19,000 on $179,000 in income, that might not sound catastrophic, but remember, David wasn't planning to spend this money. He didn't need the $113,000. He was forced to take it. And if he has any other income we haven't accounted for, a small pension, a capital gain from rebalancing his portfolio, rental income, he starts creeping toward the 24% bracket. That threshold is $211,400. And that brings us to the domino that operates differently from anything else in the tax code. So if this is helping you, by the way, see your retirement income differently, consider subscribing. We put out videos regularly like this with real numbers, real strategies, and no fluff. And if you want to see how these numbers look for your situation, there's a link in the description below. So the third domino is IRMAA income-related monthly adjustment amounts. These are surcharges on your Medicare Part B and Part D premiums, and they operate as a cliff. We've talked about them before in other videos. Not a gradual slope, just a cliff. In 2026, the threshold for a married couple is $218,000 in modified adjusted gross income. David and Karen's MAGI in our base scenario is about $179,208. So they're below the line. Barely. But here's what I need you to see. They have $39,000 of headroom. That sounds like a lot until you realize what it eats up. A $30,000 capital gain from portfolio rebalancing, a $20,000 Roth conversion they thought was small, a year-end mutual fund distribution, a pension payment, rental income, one good year in a taxable account. Cross that $218,000 line by even a single dollar, and the surcharge, of course, for a couple is $2,297 per year in additional Medicare premiums. That's not a percentage, it's a flat cost triggered by crossing a line. and it lasts for the full year. IRMAA also uses a 2-year look back, which means a decision you make in 2026 affects your premiums in 2028. It's one of those things that bites you long after you've forgotten the trigger. At higher MAGI levels, the damage escalates fast. At the highest income tiers, IRMAA surcharges for a couple can exceed $12,000 per year. The fourth domino is subtler, but it adds up. You may have heard about the new senior standard deduction from the One Big Beautiful Bill Act. It's $6,000 per person age 65 or older, which sounds great, but it phases out starting at $150,000 in MAGI for married couples, shrinking by 6% of every dollar above that threshold. David and Karen are at $179,000. They lose about $1,750 of each person's $6,000 deduction. Not all of it, but enough to matter. At their 22% tax rate, that phase out wipes out over $770 of the tax savings they should have received. Instead of a $12,000 deduction, they get about $8,495. And if their income climbs higher, say from a Roth conversion or capital gain, that deduction shrinks further, disappearing entirely above $250,000. Now, Virginia adds its own layer. The top state rate is 5.75% on income above $17,000, and Virginia's age deduction phases out at relatively low income levels. Every state's going to be a little different. David and Karen's Virginia tax bill on the RMD inflation income or RMD inflated income is approximately $5,899. So let's total it up. David and Karen's $113,208 RMD generates roughly $9,171 in federal income tax before the partial senior deduction, $5,899 in Virginia state tax, a reduced senior deduction that cost them about $770 in additional federal tax, and IRMAA exposure that sits right on the edge. Their combined tax burden is approximately $25,000 on a withdrawal they didn't want to take. That's an effective tax rate of about 22%, and it gets worse from here. The required minimum distribution amount will increase every year, assuming the portfolio value remains flat or has growth. So which of these four dominoes surprised you most? For me, it's still the lost senior deductions. I'd love to hear what hit hardest for you. Now, here's the part that still gets to me, even after running these numbers with clients for years. Everything I just showed you, that's Year 1, age 73, the divisor is 26.5. At age 74, it drops to 25.5. At 75, it's 24.6. At 80, it's 20.2. On a static $3 million balance, not accounting for any growth, the forced withdrawal at 80 is $148,515. That's a 31% increase from age 73. But here's the part most projections leave out. In the early years, if your IRA is earning 6%, which isn't guaranteed, and you're only withdrawing about 3.8%, the account is actually growing despite the distributions. A $3 million IRA earning 6% could be worth $3.5 million or more by 80. That pushes the actual RMD toward $175,000. In the Cascade I just walked you through, every domino hits harder at $175,000 than at $113,000. The IRS isn't just taking a percentage, they're taking a growing percentage of a growing number. And one more thing before we talk solutions, and this is of course time sensitive. If you turn 73 in 2025 and haven't taken your first RMD yet, your deadline is April 1st of 2026. That's less than a month or two from now, depending upon when you're watching this. And if you take it in 2026, you also owe your regular 2026 RMD by December 31. That's 2 full RMDs in a single calendar year, roughly $230,000 or more in forced taxable distributions. On a $3 million IRA, that would almost certainly push you into the 24% bracket and trigger IRMAA surcharges for 2028. Now, if this applies to you, talk to your advisor this week or call us at Covenant Wealth Advisors. Not this month, this week. If you don't have a financial advisor, again, you can call us here or just use the link down below. We manage these situations pretty frequently. So let me show you what this looks like when someone does plan ahead. Robert and Linda are the same age as David and Karen, same combined Social Security. But Robert started working with an advisor at 62. Over 9 years, they did strategic Roth conversions, filling up to the top of the 22% bracket each year, converting roughly $150,000 to $180,000 annually. They paid tax on those conversions, yes, but by the time Robert turned 73, his traditional IRA balance was down to about $1.2 million. Again, this is hypothetical, but watch what happens. His RMD at 73, about $45,283, not $113,208. Remember David and Karen's Cascade? Robert and Linda's smaller RMD keeps their provisional income well below the IRMAA cliff. Their Social Security is still partially taxable. Those frozen thresholds catch almost everyone, but they're paying tax on a much smaller base. Their combined federal and state tax burden on the RMD is roughly $7,100, not $25,000. So the difference? Roughly $18,000 per year. And that gap widens every year as the divisor shrinks. So what can you actually do? That depends on where you are right now. If you're between 59.5 and 72, you're in what I call the golden window. Your earned income may be lower. Your RMDs haven't started. You can convert traditional IRA dollars to Roth, pay tax at today's rates, and permanently reduce your future RMD base. The money grows tax-free from that point on, and Roth accounts have no RMDs during your lifetime. Under current law, the bracket structure made permanent by the One Big Beautiful Bill Act. You have more certainty than we've had in years about what you're working with. Though Congress, by the way, can always change the law down the road. One critical rule, once your RMDs have started, you must take the current year's RMD before doing any Roth conversion. The conversion cannot count toward your RMD. And larger conversions will increase your MAGI, which can trigger IRMAA 2 years later. So this needs to be mapped out carefully. It's not a one-size-fits-all strategy. Roth conversions are taxable events, so be sure you're working with an advisor who does tax planning to determine whether this makes sense for your situation. This is a conversation you'll want to have with your spouse because it affects both of your Medicare premiums and your combined retirement income strategy for the next 20 years or more. If you're already 70 and a half or older and you give to charity, this might be the most powerful tool in the box, and it got even stronger in 2026. A QCD lets you send money directly from your IRA to a qualified 501c3 charity. It counts towards satisfying your RMD, but is completely excluded from your taxable income. Not a deduction and exclusion. The distinction really does matter. The 2026 limit is $111,000 per individual, $222,000 for a couple. So on David's $113,208 RMD, he could direct $111,000 via QCD, leaving just $2,208 in taxable distribution. That one move could drop their provisional income below the threshold where Social Security taxation gets maximized. Keep them well clear of IRMAA and potentially save them $15,000 or more in taxes. And here's what changed. The One Big Beautiful Bill Act added a 0.5% AGI floor on itemized charitable deductions and capped the benefit at 35% for the highest bracket. QCDs bypass both of those limitations entirely. So if you were already planning to give to charity, the QCD is often the more tax-efficient path. In one catch, QCDs can't go to donor-advised funds or private foundations, and they must go directly from your IRA custodian to the charity, not from your checking account after the distribution. Even if you're already past 73, you still have control over when in the year to take distributions, how you coordinate with other income, and where you hold different types of assets. Tax-efficient asset location, holding your most tax-inefficient investments inside the IRA, for example, can reduce the drag on accounts you're being forced to draw down. If you have a spouse, a friend, or family member who's approaching 73 with a large IRA, or even someone in their early 60s who still has time, go ahead and forward this video to them. Seriously, text it, email it. Depending on their situation, this is the kind of thing that could potentially save someone thousands, even $15,000 or more per year. And most people don't find out about it until the first tax bill arrives, or maybe never. Now look, I just gave you the framework, but the specific numbers for your situation are going to be different from David and Karen's. Your Social Security amount is different. Your other income is different. Your state taxes may be different. And the Roth conversion math is deeply personal. So if you'd like to see how this four-domino cascade applies to your specific IRA balance and income picture, we offer a complimentary retirement strategy session aimed at seeing how we can help you. No obligation, just a clear conversation of your options under current law. Visit covenantwealthadvisors.com or use the link in the description below. Thanks so much. We'll see you next time.